Well, let's invite experts who are long-time watchers of India. Rana Gupta, Managing Director, India Equities for Manulife Asset Management, has joined us from the phone line from Singapore. And Sanjay Dutt of Quantum Securities has also joined us. Good morning, gentlemen. Thank you very much for joining me. Rana, first to you. FIs have been selling India. I think that's part of the EM basket. Does that change now with the chance of a stable government?
I think you're right, Lata. I think FIs have been a bit cautious in the emerging markets, particularly since May 1, since this tariff war kind of restarted. But I think that said, there are certain inter-specific positives have emerged. As we were discussing, that there is a stable government, there is prospect of a stable government with NDA greater than expected majority. That should mean that continuation of policies regarding formalization, regarding public investment, and maybe continue the healthier private sector banks, so on and so forth. And also some comfort on the fiscal side, which should enable RBI to move a bit on the monetary side. So all this put together, India looks, Indian equities, Indian assets look good. And also you have to add the regional context. In a trade war scenario, India gets much less impacted, much less directly impacted than the other regional markets, right? So put all this two together, I think short-term to medium-term, the prospects of Indian assets look quite good.
Sanjay, good morning. Thanks a lot for joining us after a long time. You were making this point in my conversations with you that it's a good time to start buying into mid-caps. Do you believe going forward we could have a big rally for portfolio investors? They've missed out or have felt missed out over the last 2 years. You reckon things could change?
I think so, because the biggest benefit of if these exit polls are correct and we even come to the lower end of the range of the exit polls, which talks about 270, 280 for the NDA, I think at least we're reasonably sure that we'll have Prime Minister Modi heading the government. So which translates into continuity in terms of fiscal, monetary policies, key constitutional posts that we have today. And also, most critical thing is that we are going to, deal with a known set of people who we know what their mindset and thought is about the economy and policies ahead, instead of looking at the other end, which would have been a ragtag coalition. Leaving aside all this, Gyan, coming to a specific question, I think definitely, irrespective of what the political formation that comes, select second-run companies, mid-caps, are set for a big re-rating now, primarily because they've aggressively set right their balance sheets. Debt has turned into a new four-letter word for India. I talked to promoters across spectrum, and none of them want to over-leverage or leverage. And even if some of them want to do it, the bankers are not willing to actually take positions. In fact, most of the credit markets, which Lata would know better, actually are very tight and very uncomfortable, even lending to the best names today. So that's a very positive sign for, balance sheets, for us equity analysts, that over the next few years, we will not see rampant debt-based, pure credit-based expansion or pure credit-based working capital ballooning going on in the system, which eventually leads to a collapse like what we've seen in the last 2-3 years. And mid-cap companies are much better placed because the larger cap companies are still dealing with their debt restructuring and those kind of problems.
Okay. Sanjay, hi, good morning. So how does a long-term investor approach it now? I mean, you spoke about mid-caps versus large caps, but within large caps, is this a good time to be lapping up on some of these economy-facing market leaders, the NBFCs, the Marutis, the Asian Paints of the world? Or would you wait a while, at least until the election verdict is out of the way?
No, obviously, I wouldn't jump to taking positions today, because I think this 250-odd point Nifty would probably be sold into, or even if it's not sold into, it will just sustain because of some short covering. There are a large number of shorts which are still there in the system because people were looking at election uncertainties. Quite a few of them would actually be covering aggressively today. because even if they take the worst case of exit polls, they wouldn't be in a comfortable position to hold their shorts. So, in any case, I would advise investment positions to be taken 2 days later when we have a clear government. There will be enough opportunities, there will be volatility. And individual stocks, you buy them 5 or 10% higher. It doesn't make a difference if you're adding to a portfolio for 2 or 5 years, It's not going to matter whether I bought Maruti 10% expensive today or 5% cheaper yesterday, if I'm going to hold it for the next 4 or 5 years. So therefore, investment decisions have to be 2-3 days later. Coming to your very specific questions, economy-facing stocks, I think some of the consumption names still have a problem. I think auto still has a problem to deal with. It's more a structural problem in the industry than a pure macroeconomy-related problem, because auto is kind of adjusting to a new reality in terms of nature of technology.
Yes.
Kind of vehicles, diesel, a lot of things being thrown at it. And that adjustment is still happening. It hasn't happened as yet. It's going to take a little more time. So therefore, technology will be just kind of, automotive sector will just kind of be random. But if I were to take a bet today, means that's today, meaning after the election results, I would definitely go into infrastructure-focused stocks, because that's one place government realizes there is no other option to be aggressive, because private investment and capex will not pick up instantly. Government expenditure will have to sustain the economy, will have to sustain jobs, because government is cognizant of the fact that they have to address the job and the immediate economy problem. So which will obviously can only be done in the immediate short term through government expenditure over the next few years or few months, So therefore, cement, steel, some capital goods, these are kind of areas where you need to look at, good buys right now. And then with time, when consumption starts to pick up, companies get confident that more disposable income is coming in the hands of consumer, which obviously it will as time goes by over the next 6 to 12 months. Then I think we will see a large number of consumption companies getting re-rated. But maybe a good time to buy some of the beaten down consumption plays
Fair
also,
point.
because this is a contrarian call you may want to take.
Okay, point taken, Sanjay. Let me ask Rana this same question. Rana, we are battling two headwinds. One, of course, is the global away EM trade or anti-EM trade, as well as an earnings famine, if you please, for the last 5 years, and that's not been rectified even in the ongoing quarter. What would you pick? Would you start picking consumption? Would you start picking financials?
So we would have a constructive view on the following sectors which are benefiting from the current top-down policies. For example, I think one of the things that this government has done, they have made the economy more formal. So organized, i.e. the state sector companies have gained in many cases at the expense of unorganized sector. So I think that is one. Then as the other speaker was also pointing out, that this government has been fairly aggressive, and we hope that they will continue to be aggressive on public investment. That should continue to benefit some of the industrials and building materials names. Additionally, Lata, as you are very well aware, that because of IBC, the private bank balance sheet has transformed. The private sector banks, right? So they are also, I think, another part of the market which looks good. Having said that, I think you mentioned that when the earnings discussion kind of comes off and the consumer stocks pick up, we think there is time to that. And for that, in our view, we say that 3 things need to happen, and we call them 3 R's. It is recycling, rebuilding, and reinvestment. Okay. Recycling means that government should continue with their capex, government should continue with the investment, that is what is required, but hopefully recycling the capital from non-strategic investment.
Okay.
Rebuilding is basically let the private sector capex come back from the domestic investments and domestic income and savings, and reinvest is basically in taking advantage of the regional context, whereby we are seeing US-China trade war, and we are seeing China's move to high value-added economy. So there are a lot of manufacturing opportunities which can come India's way. Government has to set up the proper enabling framework to capture them. So all these things happen, then the rally broadens out, then I think you can talk about a much
broader
from here.
Okay. Sanjay, the other point which a lot of people have made is that, We went through a period where the market sort of became immune to FII outflows. That's because the domestic liquidity was way too strong. Over the last 3 months, we had seen a bit of a slowdown. You reckon you will have a second round of big domestic buying, which once again would make the Indian market a bit more resilient, than it was, say, for last 3 or 6 months?
Definitely, Anuj, because I have seen, from my private client group and particularly the high net worth client group, last 3 months they've been, why 3 months? For the last 6 months they've been earned so badly whenever they've gone and taken positions that they've become, not only risk averse, they've totally kind of deserted the market and, not taken any kind of investment positions or any even, longer term trading positions in the F&O segments. So I think that segment of the market will now get much more confidence to come back. So therefore, those flows, not only just from mutual funds and SIPs, etc., but the private client flows, the PNS flows, I think those flows will now start coming into the markets. And if I'm correct, there is a thinking that's going on in the, policymakers that are in the government, that's Finance Ministry, Commerce Ministry combined, that they're going to open the floodgates for foreigners to come in to invest. Foreigners meaning not FIIs, but what I hear is that we may just have foreign individuals, just like Indian individuals, allowed to invest $250,000 overseas, irrespective of where you want to put the money. They may just come up with, a reciprocal kind of an arrangement here, where a foreign individual who's not a citizen of India, not a non-resident Indian, who's basically a foreign citizen, he or she may be allowed to come into India and invest directly as long as a proper KYC and an authorized dealer, that's a banking channel, is used to get the money in. If my information is correct and if these proposals are being discussed and the same government is coming back, I think that's going to be huge amount of money, which no one really be able to understand the impact it will have on the market. And more than that, sentiment in terms of, India is open for business. So these kind of developments, I think, will have a lot of bearing on the Indian markets. One more thing unrelated to what you asked me, Anuj, and of course, Lata would maybe to an extent agree with me, and she's a better expert on this. I think it's time for the PSU banking sector to be re-rated on the stock markets, because the kind of provisioning, the kind of cleanup, the kind of, total management practices in terms of lending, ultra-conservative lending that's happening, that's, I think, going to transform and improve the, earnings and balance sheets of banks. And obviously, a good amount of money may just come back in writing back some of the IBC cases and some of the other loan cases. Yes, problems do exist, but I don't think the valuation gap that is there between private banks and these public sector banks would remain where it is, because we can't have industry, public or private investment growing in India with just on 4 large banks, that's HDFC, Kotak and IndusInd. We will have to have the public sector banks also joining in, which includes SBI, Canara, PNB, the ones which are the bigger ones and cleaned up totally now, and Bank of Baroda. Yeah. So I think they will now join in and give much better returns to investors in the next 2 years. I don't know when that happens, whether it starts to happen next month or whether it happens 12 months later, but we'll have to have patience and take that confident call now.
Okay. Well, Sanjay and Rana, thank you so much for stopping by and speaking with us. The sum and substance of the discussion is that, yes, the sentiment has picked up post the exit polls, and there will be perhaps policy continuity. That's something that foreign investors are looking forward to if the BJP-led NDA government gets a majority.